Welcome back to Focus on the Future. Most of us never think we're going to be affected by what happens on Wall Street and in markets throughout the world. But the truth is, what happens in financial markets doesn't just stay there. Those happenings sometimes percolate throughout the economy of every country in the world, creating boom and bust cycles. Why should you care? Well, for one thing, almost 80% of all Americans are owners of common stock, either outright or through investments in mutual funds. There is also no question that we're all impacted when an economic bubble bursts, like the recent downturn in housing with increasing foreclosures and property values plummeting. So today, we're going to explore the investing relationship and how establishing one could be extremely important to your future. Our guest is our own Tom Crow, co-host of the Stock Market Corner and an outstanding financial advisor in his own right, and of course a money manager as well. Welcome to this segment of Focus on the Future, Tom.
Great to be here.
Great to see you today.
Good.
Let's just start with a basic question.
Sure.
Crow Financial is the company you own. I know you've talked about it before, but tell us what they do and what actually do you do every day?
Well, in a nutshell, we are registered investment advisors, which means we manage money for other people. Mm-hmm. And on a day-to-day basis, it's looking at individual accounts and individual holdings and making sure that their investments are performing such that they meet their investment goals that we've set aside ahead of time.
Okay. I assume that you then set parameters, your clients, and decided what a parameter should be.
What level of risk they're comfortable with,
right.
how much they can afford to put at risk, what kind of income needs or growth needs they need to achieve a retirement, savings, investment, whatever kind of goals they have.
You know, one of the most interesting questions I think I've ever heard from an investment advisor was one that I talked to several years ago, and he says, if you went to sleep one night with $100,000 in your investment portfolio and you woke up and it was worth $80,000, could you live with that?
Right.
And he was kind of setting a risk profile. So when you talk about they're all different for everybody, aren't they?
Absolutely. Everybody's got a different risk profile, and most people will err to the risk side. In other words, when you're making money, they don't mind taking risk. But as soon as you wake up that morning and you're down 20,000, all of a sudden they become very risk averse very quickly,
yeah.
and they get a little bit vocal and sometimes irritated about that.
You know, I've heard people compare investing to gambling. My personal feeling is that's not true.
I've never liked that analogy, just because gambling is a total odds thing, like a flip of the coin.
Right.
And you know, the further into the house you get, the more the odds seem to stack up against you. You know, I've often heard the when to walk out is after you've won your first hand, because then you know your odds are 50-50. If you win the first one, turn around and walk out, because that's as good as it's ever going to be for your time in the casino.
A lot of truth.
There's so much research that goes into what we do in the markets, in that I don't feel like we're just putting money on a roulette wheel or picking a color and letting the ball go and see what happens.
See, I think, and the reason I brought that up is because I think that really is the reason behind the importance of an investing relationship.
Sure.
Now, when I say that, investing relationship, what the heck does that mean,
right.
really?
Well, you know, if you want to invest in stocks, bonds, anything, you can't just walk onto the floor of the New York Exchange and start waving your hand and buying stocks. You have to have somebody act on your behalf to make that purchase. Whether you're doing it through mutual funds or through a bank like CDs, or if you're going to do individual stocks through an online brokerage. I don't even have direct access to an exchange. I use a custodian, which is a company that houses my clients' funds, and through them I place trades to various markets.
Right, and that custodian has access to a seat on the Wall Street exchanges.
Exactly. They have traders on the floor. They have access to what they call market makers, which are the heavyweights in one individual stock, and they will then place the trades, and then they come back to the custodian. You know, cash goes one way, stocks go the other.
Right, I got it. How does one go about finding an investment advisor that's reputable and honest? I mean, because Bernie Madoff, for example, comes to mind, and other people that have defrauded potential investors and investors throughout a lot of times. So how do I know?
Well, I mean, the first thing to start out with is whether or not they're legal. You can do that by going to the SEC's website. That's the Securities and Exchange Commission. That is our government regulatory agency. And you go to sec.gov, and search for either a broker or an investment advisor. They're categorized differently. But type in the person's name, the company name, they should come up, and you should see their whole business history and record, whether or not they've been sued, what their education is, how long they've been in business, how they do business, how they get paid, should all be there online. But Bernie Madoff had a clean record with the SEC. In fact, I think his son-in-law or nephew-in-law or something was his investigator.
Right.
So you got to interview the person. You got to know what you're getting into with them. You got to make sure you've got a common understanding and that there's somebody you can get along with. I mean, there's clients that come in here that we end up not working with because there's just too vast a difference in opinion or attitude towards investing, and it's just not going to be a good relationship. And you have to decide early on in the relationship whether it's going to be somebody that you're willing to hand over that control to if you're going to do an advisory relationship. If you're just going to buy and sell stocks yourself, then you're going to find a broker who gets paid on the commission, or you're just going to go online to an E-Trade or a Scottrade where you're just going to place the trade yourself and pay the minimum commission you can.
Right, right. Well, I suppose there's some value in learning what it is what your objectives really are, because I think a lot of us don't understand even where we want to be from an investment standpoint. Now, I don't suppose that most folks, at least, wake up one morning and say, gee, I'm an investor.
Not really.
It kind of starts with basic savings, doesn't it?
Always, yeah. You've got to have something to start off with.
Right. So what's a reasonable number? How much do I have to save before I can, quote, become an investor?
And when you become an investment professional, you get better at asking questions. So my question to you is, how much can you lose?
Okay.
That's what you have to start with. Whatever you're going to invest in the market, depending on your investment profile and what kind of risk you're going to take, you've got to understand that it may not be immediately liquid, meaning you can't get back to cash right away if you need it.
Right.
And you could lose it all. And that is that's always, even in the safest investments out there, the municipal bonds, the bank CDs, if they're FDIC insured, you will get your money back eventually. But when we had a bunch of banks fail last year, some people were locked out of their money for weeks at a time.
That's true.
While the banks were shuffling around and being acquired and moving funds back and forth and making sure they knew who owned what CDs and getting their money back to them.
Well, you mentioned FDIC, which insures bank accounts and CDs, et cetera. There's something in the securities business called SIPC, SIPC.
SIPC.
What does that stand for?
Security
Investors Protection Corporation.
Yeah,
right.
And they insure investment accounts against fraud and loss, not against investment loss. That's what some people think. Well, I have insurance if I'll never lose money.
Right.
No. What they insure you for is if the company who is your custodian goes out of business or leaves the country, just disappears one night, then they will insure that account for the amount that you've lost.
I gotcha.
It's a fraud and kind of a backup insurance.
So let me kind of follow you through this. I've saved a little money and I'm willing to risk it all, but I'm really not risking it all. I mean, I guess I could be. If I bought General Motors, for example, 3 years ago, I would have risked it all.
If you bought GM bonds, yeah.
Yeah, I would have lost it all.
Yeah, you can never predict a bankruptcy.
Right.
You never know when that's going to happen.
Those things do happen.
And you can buy right now, we're seeing in Europe, you buy government bonds. These sovereign bonds are supposed to be great bets. And, all of a sudden you got the potential of Greece defaulting.
That's true.
And if they don't reach a settlement, you could lose everything there, too.
And or Italy and or Spain.
Or Italy, Spain, Ireland.
The dominoes may fall.
That's right.
That's true. Well, all right. So, again, I've saved enough money. I want to become an investor. I find the investment advisor that I like. What should be my objective? I mean, how do I determine what that objective is? Is it always retirement, or can I have short-term goals?
We have folks that come in and invest for their kids' education. In which case, we're going to take a very conservative profile, probably mostly bonds, that are going to mature out somewhere. So you're going to invest a certain amount now with the intention of having slightly more than that in the future, just so it doesn't sit in a savings account right now, which is paying nothing.
Right.
They want to do something with their money. They've got the cash now. They want it set aside so they can do something with it in the future. And whether that's 5 years or 10 years or 15 years, that determines how we put together a portfolio of bonds or investments, stocks, anything for them to try and reach those goals out there when they decide it's time to take the money out. they want to have a certain amount set aside. And it's, it's not different than retirement. It's kind of the same question you're answering. How much are you going to need in terms of income in retirement? How much are you setting aside now? What does that look like as it's growing over time? What do you need to achieve in terms of market return over that period to have enough money when you decide it's time to retire, based on your projections, that you're not going to run out of money?
Well, it may also be that I want to buy a car or I want to buy a house. And so I'm looking at growing my investment portfolio towards that end.
Right.
Those can also be goals, right?
Those can be great goals. A lot of times we'll say now, given the volatility in this market and how long it's been since we've had a really good, predictable, stable market, people are saying if you need that money within 3 to 5 years, you really want to take a very low-risk approach to it.
3 to 5 years?
3 to 5 years,
wow.
Just because it's so risky out there and so difficult to make money in this environment. You tend to win as much as you lose right now, and it's been very difficult to see any kind of real growth.
When I first started investing, Tom, the philosophy on the street, using the parlance, was buy and hold. And frankly, it worked out pretty well for me. I had returns on an annual basis, 10 to 12%, pretty consistently. That hasn't happened in the last 10, 15 years, has it?
I think if you go back to 2000, we're still looking at a net loss on the market. So we're going on 12 years now where you've basically made nothing.
I think historically that's never happened before.
It never ever happened before. You used to always be able to, I think the percentage thrown out for years and years was about 13% a year. You could expect in stocks.
Right.
And bonds you could expect 5 to 7% a year.
Right.
And that was just what you did. Now bond yields are so low, you're getting less than 5% a year in most bonds.
It's not worth the risk.
And your stock market returns are net negative right now.
So you would suggest that buy and hold is broken?
I always have. In fact, you talk about risk, and the riskiest thing you can do is buy one thing or a few things, not be well diversified, and then forget about it. Just for the reason we just talked about, GM. So I love GM, I like their cars, I like their corporate philosophy. I'm putting all my money in GM, and they go bankrupt.
Then you're finished.
The Enron employees that had tons of Enron stock in their 401k because it was the best return. The market, the bonds couldn't compete with Enron's return. So they had 40, 50, 60% of their 401ks in Enron stock. And Enron goes poof overnight, and those people are wiped out.
Well, there's lots of stories like that.
There always are, unfortunately.
Lots and lots. I mean, there's even companies that don't go bankrupt, but they're selling their stock at $80 and suddenly it's 20.
Right.
And it stays there for a long time.
Or 2.
Yeah.
We saw a lot of stocks in the early 2000s when the technology bubble burst.
Yes.
And we had stocks that weren't making any money that we'd buy at 50 or 60, sell at 150. And then a year later, they'd be at $1.
Right.
Just because there was nothing there, no earnings, and they'd lose all support in the market.
Now, one of the ways to diversify that risk is through mutual funds.
Right.
And that's what most Americans invest in, is it not?
Right.
I would guess overwhelmingly so.
Most 401k plans, most investors are in 401k plans.
Right.
Most 401k plans offer either mutual funds, individual funds, or funds of funds that is a managed portfolio.
Now, you've said two things that we're going to have to define for us. Let's first of all tackle mutual funds.
Okay.
What in the world is that?
A mutual fund is actually an investment company.
Okay.
So in this case, the mutual fund company would be your investment relationship. You send them money, and they, according to a set of rules that they have established for any given fund, which is an investment profile, they invest your money just like everybody else that has money in that fund.
Okay.
They go to the market, they buy the stocks, they buy the bonds, they hold them, they keep track of your shares, and they report to you at the end of the day what's called net asset value, which is what they own divided by the number of shares of investors.
Right.
And that's how classic open-end, which is the 5-letter symbol fund, is priced at the end of the day on the net asset value.
Okay. Now, there's some information about the fund and what they invest in, so I can look at it, my advisor can look at it and see if it meets with my expectations and my goals.
I think there's at least 10,000 out there to choose from.
Oh my gosh, that's a lot to choose from.
Another reason to have an investment professional
well,
who at least kind of can steer you in the direction you want to be to meet your goals.
All right, and then the other thing you mentioned was that number, 401 what?
The 401k.
401k, what's that?
That's if you work for a company that has a retirement plan, a 401k is kind of like a super IRA. If you have the opportunity to invest in a 401k through your employer, you should. You can defer income, basically meaning you're not going to pay taxes on it now.
Right.
And you can put quite a bit more into a 401k as a percentage of your earnings than you can a traditional IRA or a Roth.
So an individual retirement account, which is what you're referring to, an IRA
Yes.
being, and a Roth being something that is an aberration of the.
One's tax coming in, one's tax coming out.
I understand. So the limits on those are less than the 401k?
Yes.
I got you.
Yeah, the 401k, I think you can do up to 16, almost 17,000 a year.
Okay.
Or 20% of your income. So you can't make 16,000 and put all of it in a 401k.
Right, right.
But you can put, I think, only up to 5,000 or 6,000 in an IRA, depending on your age.
I believe that's correct. And if you're over 50, there's a
You get a
catch-up
catch-up.
clause. We don't want to get into that.
Right.
But okay, so these 401ks. Give me choices of mutual funds that I can pick, or
Right.
other investments that I can pick.
Sometimes they'll give you a list of funds to choose from. Sometimes they'll give you just a profile to choose, which will be anything from conservative to aggressive risk. And you might have 4 or 5 steps along the way. In that case, they're usually managing a fund of funds. So they're out choosing the funds to meet that investment profile. And where you say the ultimate conservative fund would be almost cash, probably all short-term bonds. And the most aggressive would be, as much as 90, maybe even 100% stock with
Right.
no bonds in it.
Right.
And then you'd have steps in between where you'd have a 50-50, a 70-30 allocation between stocks and bonds, depending on the kind of risk you want to take.
I'm with
Typically,
you.
just what you're thinking about in terms of market risk in your age, the older you get, they say the more conservative you want to become, so you don't have so much out there at risk to lose.
Makes a lot of sense. One last question.
Yes.
And this is going to put you on the spot.
Okay.
If you were a brand new investor today, what steps would you take first? What would you do? And what would you buy today?
What would I buy today? Boy, probably not the market. It's a little bit scary right now. I'd be very careful about getting in this market. It's tough to look at CDs as a serious investment because they're not paying anything. They are very safe, but you're going to be stuck in one of those for 2, 3, 4, 5 years just to get a couple percent out. And if you look at the rate of inflation, which is a couple percent a year, you're losing money very safely.
Right.
Which you don't want to do.
No.
You also, but some people are willing just to, not lose anything. And my argument in that case is then, don't invest.
Put it under your mattress.
Put it under your mattress. Again, you're losing purchasing power to
Sure.
inflation, but you don't have it at risk.
You can count it every day.
You can look at, you can count it every day. And you can look at government securities, at U.S. government securities, which right now, even though we have a slight tick down in our credit worthiness, still one of the best investments out there, and you're going to get very little return on that as well. You can go out to a 30-year bond and get a couple 3%. There are Treasury inflation-protected securities that are called TIPS that adjust their payment with inflation, which are nice.
That's nice.
And you can get an ETF or an
exchange-traded
fund, which
Right.
is a different kind of mutual fund. You can get mutual funds or exchange-traded funds that buy baskets of TIPS, which I've been buying quite a bit of lately, looking for some inflation with the amount of money we're flooding the market with all the other foreign countries' debts blowing up.
Right.
Inflation's not a bad bet right now. That we're going to see some inflation on the horizon.
One would certainly think
Some
so.
kind of inflation-adjusted security is a great way to go. Another hedge against inflation is gold. I don't. A lot of advisors and a lot of radio commercials are trying to sell you gold. You got to think about what's being pushed here in this case. If these are the so-called gold experts and they want you to buy gold, that means they want to sell gold.
They're selling it for dollars, aren't
This
they?
gets into a brokerage relationship as well. I'm an investment advisor. I get paid a fee based on the size of the account I manage. So the way I make more money is to make my clients' accounts larger.
Sure.
If I'm a broker, I'm getting paid on the transaction. That means if I want to make money, I've got to buy or sell something for the client. So if these guys are selling gold, they want you to be buying it. Well, and likewise, you go to a broker and say, hey, I want to buy anything, Dell computer. And they say, great, we want to sell you a Dell computer. Well, if you want to sell me Dell computer, then why do I want to be buying it? I want to be buying stocks that you want to be buying.
Now we're talking why you really need an investment advisor, and we've come full circle,
Exactly.
no question about that. Thanks so much for being with us today and taking the time out of your busy day to. And
It's
I
my
guess
pleasure.
we'll see you again on the Stock Market Corner right
Yes.
away. Thank
Super.
you. So, what'd you think, Emily? Pretty good interview, I thought.
There's a whole lot of information when it comes to investing. It's complicated to me, and I would assume a lot of other folks. It makes sense to have someone like Tom, a qualified, registered investment advisor or broker, whatever works for you. Make sure that they're certified. You don't want it to be a Bernie Madoff type situation where somebody steals all of your money. And you know what? It is your money. And so if this person doesn't have the right attitude, you guys don't really jive, don't be afraid to go someplace else.
Well, I think that makes a lot of sense. And one of the things I've heard Tom say in the Stock Market Corner over and over again is that these markets have an awful lot of different moving parts. And I think that's why it's so important to establish this early on, an investment relationship. But you're right. If the things are not going the way you see that they should go, change.
And you know what? I think before you even walk into someone's office, you should probably do a little bit of self-research. Figure out what exactly your investment goals are, what are you looking forward to in the future, and what type of investor do you want to be? Could you handle a lot of risk? Does that make you nervous? Do a little self-assessment.
Isn't it interesting, and I think it's fascinating really, that every relationship we talk about, whether it be banking, insurance, investing, we always come back to doing your own personal research and taking some personal responsibility for your financial matters. And when you start talking about personal finance, that really is the answer, guys. It's up to you. There are people out there that will help you, but you got to find out which ones work for you.
And you know what? The future is coming, whether we realize it or not. And I have to think about, well, retirement hopefully is coming down the road. And so it seems like a long way off, but you have to plan for your future. You have to set these goals. What do you want to achieve and how are you going to do it?
Well, it's coming for me a lot quicker than it's coming for you.
I know, 30 years seems like a long time for me.
Well, 30 years is a long time, but you know, it's not a long time in terms of financial investing and putting things together. 30 years comes pretty fast.
I know, I hope.
So good advice, get yourself a good investment advisor, do the research.
And get ready for the future. It's an exciting time. So
focus on the future, guys. Right. What's next?
Next, stay with us for Budget Busters, to be followed by the Stock Market Corner.
We'll see you all next week.
Thanks, guys. Hi, welcome back. This week, we're revisiting one of our favorite things, our ride. Okay, we've discussed how much of your budget should be allocated for the car payment and car insurance. Today, we're going to talk about maintaining your cool ride and keeping it working well. Remember that you'll end up spending more money on things like gas and oil if you don't take good care of your car, so that's where we're going to start today. Auto maintenance is not a regular monthly expense, hopefully, but in the event that you choose to drive a 20-year-old beater, you're probably sinking a lot of money into it and just killing your budget. For the rest of us, maintenance is likely an every 3-month expense for the 3,000-mile oil change. You could stretch your money a little further, you could wait a little bit longer, but don't drive more than 6,000 miles without changing that oil. Oh yeah. And do you realize that tires wear out? I know, it's a big shocker, but they don't last forever. Keep in mind the way you drive will help you get more wear out of those tires, which can last a couple years or maybe up to 50,000 miles. Also, stuff on your car will break, if it hasn't happened already. The more cool things you have on your car, the more likely you'll have to have them repaired or replaced. I know, the dollar signs are adding up in your head fast. So what's the magical amount you should set aside every month for your car? It's going to depend on how many miles a year you drive and how old the vehicle is. Here's my rule of thumb. 22 cents per mile driven each month for a vehicle less than 3 years old, 31 cents per mile if it's any older. If you're driving that 20-year-old beater, forget about your budget. You can't afford it. So let's put a dollar amount on it. If you drive 300 miles per month and your vehicle is less than 3 years old, you should set aside about $66 per month. If your auto is more than 3 years old, set aside about $93. If you have any money left over at the end of the year, do something fun with it, or maybe even save it. All right, let's talk about the fuel. Gas prices still tend to fluctuate, and you'll notice that some gas stations are substantially cheaper than others. So what should you budget for the fuel? Again, it depends on the current price of gas, how much you drive, and how hard you are on the engine. Don't forget, you can always walk, bike, or take public transportation to save a little bit of money here. I suggest that you budget about 25 cents per mile and make sure that you pay cash for the gas. If you use your credit card, you could be paying a heck of a lot more than $3 per gallon if you don't pay the balance off in full every month. So keep that car in good working order. I'll see you soon. Hi, welcome back to the Stock Market Corner. I'm Emily New.
And I'm Tom Crow.
How are you today, Tom?
Very well. How are you?
I'm doing good. It seems like there's some good news and all sorts of exciting stuff to talk about this week, right?
There's always exciting stuff to talk about in the markets, that's for sure.
Well, what's going on in the markets here, locally and as well as internationally? There's a lot of stuff happening too.
Well, we were actually almost on a recovery track until last night. I think the last hour of the market, Fitch's, one of our other credit rating agencies, came out with a report discussing just how much a weakening in the euro would affect U.S. banks. And that led to a huge sell-off in financials that took the market down over 100 points, the Dow, in the last hour of trading. So that kind of wiped out all the gains for the week, and I think we're back underwater for the month even.
Oh, no.
And also we've got now, this morning, Spain's bond yields spiked over 7%. So here's the last of the pigs. We had the Portugal, Italy, Ireland, Greece, and Spain.
That's what they're calling it, pigs.
That was the pigs. And now Spain has flared up as people are worried about their debt, their ability to perform on their bonds, and their bond yields are spiking. People are dumping their bonds. And again, we talked about Italy being about 12% of the EU. Spain is between 8 and 9%. Again, Greece only being 2%. Spain's big enough to matter.
Yeah.
And when people start panicking about Spain, it is going to influence our markets.
And we saw too, we were just watching in your office, that there are people running through the streets of Athens and there's more protests.
Oh, they're rioting in
Greece.
Athens, they're rioting in New York.
They are rioting in New York. And do you think that's had an effect of this whole Occupy Wall Street? And I heard that they're actually trying to prevent some of these traders, people in business suits trying to get to work. They're actually trying to prevent that from happening. There's riots in New York. Has that affected the market at all?
I think I understand where they started. I've kind of now joined the camp of people who've kind of lost patience with them. I think they've allowed so many varied voices to join their group that their message, their protest has gotten diluted and disjointed, and nobody knows what they want anymore. It seems like they just want to camp out and not work.
Which is frustrating for the rest of us who have to go to work.
And this morning, the police in New York were keeping them from, they were trying to keep Wall Street workers from getting to work, and the police were very good about not letting them do that.
That's good. That's good. Yeah, they were trying to block the subways even.
Right.
And what a huge mess. I also heard in the news this week that oil is up over $100 a barrel.
Yes.
So do you think it's fair to say that we're going to see gas prices going up right before
unfortunately,
Thanksgiving?
right before Thanksgiving, just in time for the holidays, when having cheaper gas would mean consumers had more money to spend at the stores at Christmas time, we're probably going to see a little bit of a spike in gas prices here towards the end of the year. The only thing that might save us is, another cold winter might cut down on some travel.
Right.
That might, some of the analysts might perceive a decreased demand, and that would put a little bit of downward pressure on the ability of gas prices to rise if we think there's not going to be a lot of usage. But right now, I think people got used to having gas under $3 a gallon for the last few weeks, which was great. It was more money for us, right?
Yeah, we like that.
And it takes a few weeks for that to wear off. So people aren't going to just immediately start driving less, and they're going to keep spending as much, which means we might see a little bit, people incur a little bit more debt now before they're starting to borrow to pay for Christmas, which we hope they don't do, but they're going to do it anyway.
But it is nice to have a little extra cash in your pocket when you're going to the pump. Stick your card in and go in and pay cash. I've noticed, it didn't cost me as much to fill up this week. It's nice to have a little extra cash, and they anticipate that more folks are going to be driving for the Thanksgiving holiday. So
instead of flying, it wouldn't surprise me at all.
Well, yeah, it's definitely cheaper to drive than fly. So I came across an article that I want to discuss from the Wall Street Journal, and it's titled "The Quiet Power Behind U.S. Job Growth." Wanted to get your thoughts on this, and it's talking about small business. And we've heard on the campaign trail people touting small business, and small business is a huge part of our economy, and it's going to be a big deal getting more jobs, getting folks back to work, things like that. Just want to quote a few things here. It says, there are these small businesses, those with fewer than 50 workers led the U.S. in net job growth in October for the 5th consecutive month, according to a payroll firm. And they're saying that larger companies, meanwhile, are shedding their employees. They can't keep them. And since 2001, employment at small firms has grown by 6.5%, just shy of 50 million workers. Employment at large and medium-sized firms, meanwhile, has declined. So what are your thoughts about this, and what do you think that we can expect going forward, maybe after the holiday season when we're seeing more companies probably ramping up? Are small businesses growing? I mean, is it making an impact on our economy? What do you think?
I think they are, and they always have been, and it's always been in a good economy. The better place to invest is in the small businesses. What you see is it's a matter of relative size, in that you got a mom and pop that hires 2 people, well, they just increase their payroll by 100%.
Right.
And that tends to skew the statistics, where a 3M or something with 1,000, 2,000, 3,000 employees lays off 2 or 3 people, it's a drop in the bucket.
Nobody notices.
Or they hire 2 or 3 people, it doesn't really matter.
Right.
There was also a mention there of, in that article, of offshoring and outsourcing. And the ones reporting the data are ADP, which is Advanced Data Processing, which is one of the biggest outsourcing firms. It created itself
Right.
as out of a desire for companies to get rid of their human resources department, where basically you have a big company that has a lot of employees. They sell all their employees to ADP and then hire them back as contractors, where ADP does all the payroll, all the benefits, all the retirement plans, all the health insurance, and they just work for the company. And that's why we've seen a bigger than average decline in manufacturing jobs, because when a factory sells 1,000 employees to ADP and hires them back, now they're not manufacturing jobs. They're service employees now at this point. So we've seen a big shift towards the service economy, but it doesn't mean we're losing all of our manufacturing jobs. Small businesses just are more nimble. They tend to
can adapt.
They can adapt. They can move more quickly. They usually have a lot less bureaucratic red tape. They're not subject to as many government regulations. And they can just adapt more quickly, and they are the ones that the big companies go to when they need something done right away, rather than, okay, we're going to have to hire a bunch of people and create a department to do this, or we can hire that little company over there to do it for us. And we may end up buying them out or buying all their employees away from them at some point, but if we need it done right now, we're going to go to a small business.
They've already been doing it, and they already know how to get it done.
And likewise, a small business gets a good-sized contract, their revenues percentage-wise go through the roof. Where a big company gets that same contract, it doesn't really matter much. It's going to keep a few of their people busy. So you can see a lot of, I mean, I'm a small business owner.
Right, exactly. That's what we're talking about.
I've worked for big companies. I've worked for small companies. I'm definitely a small company guy. I like the independence. I like the freedom, even though it means I have to deal with the government. I have to deal with the taxes. I have to deal with the accountants. I'd rather do that than be an employee.
I think it makes sense. And what I think I'm seeing, and there's kind of a community sentiment that we're proud to support these small businesses for you being involved in the community. And it makes sense. You're hiring local folks. You're obviously not going to be outsourcing. Being a small business owner to countries outside of the U.S., it's not even outside of your local city and state. So,
but we do outsource our payroll, which is interesting, to another small company that does payroll, because it's my wife and I. She runs the business. I run the investments. She doesn't have time to keep up with all government regulations every time the tax code changes. So we have a payroll company that we pay to do our paychecks, and they keep up with all that stuff for us. And it's cheaper for us to pay them to do it than it is for me to have her keep up with it.
It makes sense, and I'm sure we could talk about this kind of stuff all day and speculate what's going to happen, with all these changes in the politics. But before we finish up the Stock Market Corner, let's talk about our virtual portfolio.
Our virtual portfolio. As of last night, we've taken a little bit of a hit on a few things. Our semiconductor company, Atmel, we're sitting at about a 6.5% loss. So we may be, if things stay continually weak in the tech sector, we may lose that one. Bed Bath & Beyond is still right about break even. Cisco is the new addition. It's up about 3.5%. Kohl's is still sitting pretty at a 10% gain. Our little Brazilian steel company is sitting nice at a 9% gain.
Great.
So overall, our portfolio is up 3.5% versus our tracking SPY is sitting up about 1.5%.
So we're up a little bit, considering that the market had been down last night. It's probably not bad.
Right. No, we're still doing good. And just as an aside, Abercrombie & Fitch that we sold at 58 is now at about 49.
So we probably got out at a good time.
It continues to fall. So there was something weak going on. They missed earnings and they've fallen apart.
Well, it really makes sense. Kind of our whole investment philosophy in this portfolio is you have to have limits, whatever those are. 10-10, 20-20. When you're up or down, you got to stick to it. And don't be an emotional investor. You hear time and time again, people make these horribly rash decisions. There's a little bit of news comes out on the market and they're thinking, oh, I got to get out now. They're buying high and selling low, and it doesn't make sense. It doesn't make sense. But before we go, there was something that you mentioned during the interview portion.
Yes.
And I wanted to get back to that. You said there's different types of funds. We're talking about mutual funds, how most Americans are invested in mutual funds. But within that, there's a different category.
Right. There's several ways you can do that. There's an open-end mutual fund, which is your classic 5-letter symbol. Open-end fund means the fund company is your investment relationship. You send them money, they invest those funds according to an investment profile on your behalf. At the end of the day, they count up the value of what they own divided by the number of shares, and that's what's called your net asset value. That's what determines the price of the share and what you're worth. An exchange-traded fund or closed-end fund is similar
That's ETF,
That's
right?
an ETF
Okay.
or a closed-end fund. Those you buy and sell on the secondary market. So you're buying shares from somebody else instead of having a company create
okay.
shares for you. Those trade on a premium or discount to net asset value. So if it's a fund that people want and they're bidding the price higher, this is still a market. You know, and in this case, the ETFs and the closed-end funds are subject to market pressure, which means I don't care what you think it's worth what you can sell it for.
Right.
So
right.
if
Like a
people
stock.
don't like it, and they're not going to sell it for what you think it's worth, you're going to sell it at a discount. You're going to, you're going to pay less than you think it's worth. If people love the fund and they're bidding it up, then people who own it that are selling it are going to demand a higher and higher price, and that's going to drive the price higher.
Okay.
If you lift the lid off, it's still a basket of stocks. Both the open end, if it's a stock fund, whether it's a mutual fund, an open end mutual fund, or an exchange traded fund, it's still a bunch of stocks that are being bought and sold on your behalf.
A lot of stuff to know about this. I'm glad that we have you here on our show with us and to answer all these questions because it is complicated and you're the man with all the information. So,
Well, I try.
well, thanks so much for that. That finishes up here on the Stock Market Corner. Stick with us, guys. We'll see you next week.
See you next time.
And here are this week's questions for classroom discussion. Number 1, describe the investment relationship. Number 2, how much money should you budget each month for maintenance for a vehicle less than 3 years old? And finally, which country in the Eurozone is the latest to have its borrowing costs increase?